Good morning, guys. Welcome back. I have a very interesting story that I want to share with you. Got some insider boots on the ground information that I want to share with you guys. This came straight from either a loan officer or a loan processor in the mortgage industry, in the housing industry. I forget which title they have, but they're boots on the ground. There's a inbound potential catastrophe coming in, natural disaster, Hurricane Ian. Prayers go out to the families in the state of Florida. I hope that you guys are preparing. Families are stocking up on essential items or even preparing to evacuate the state if necessary, or at least evacuate to higher grounds far enough away from hopefully the eye of the storm. And so obviously we know that mortgage financing has declined drastically. The housing market has taken a huge hit in terms of the number of housing market transactions that have taken place recently. And this has everything to do with the decision that the Fed Chair Jerome Powell, as well as the Federal Reserve, has made and are taking the actions that they're taking in terms of raising the Fed funds rate, which is having a near direct impact on the mortgage rates that are being charged to homeowners. Now, for those who are not quite familiar with exactly what's going on, in a nutshell, basically what is happening is obviously the housing prices have gone up drastically in a very short period of time. We're dealing with inflation at record high inflation levels that we haven't seen in 40 years. And the Fed is attempting to reel in inflation by raising interest rates and making financing much more difficult, much more expensive to obtain, to drive down or almost suffocate the demand for buying stuff, because we have a supply chain problem with the housing market, which there was not enough inventory. So you had a shortage of houses, you had a shortage of materials, shortage of construction labor, and we had a drastic increase in demand for housing prices, for housing rather. And so this drove up the price of housing. This drove up the price of rent because new houses couldn't be built due to labor supply shortages. So I'm not going to go into all that, but here we are today. And I actually had a conversation with either a mortgage loan officer or a mortgage processor. I forget which title she has, but she was telling me how busy they were over the last 2 years. I mean, she was saying that she was making multiple six figures in income. Her commissions were higher than she's ever seen. She had so much business, it was just ridiculous. Loans were being delayed because they just couldn't close on these houses fast enough. The business was just absolutely booming. And to go from where it was over the last 18 to 24 months to where it is today, she said she began to see the decline right around May. Now, if you guys remember, Fed Chair Jerome Powell began to increase the Fed funds rate for the first time. I want to say it was March. So that first Fed funds rate was an increase of 0.25% or 25 basis points. And so for the month of March, there was really no impact because you didn't really see the big change that month. But she said by April, May, the change became fairly apparent, especially when even after the only 25 basis point increase, many lenders began increasing their rates more than 25 basis points and tried to get ahead of the interest rate increase. So you would think that, okay, if the cost to borrow goes up by 25 points, then the cost of loans will probably go up by 25 points. Well, that's not exactly what these banks and mortgage companies were doing. They basically raised their mortgage rates by 100 basis points, even though the Fed only raised theirs by 25 basis points. So they jumped ahead. They got ahead. They increased their profit margin. They literally pretty much took advantage of consumers, and they made a much larger profit for a very short period of time when that happened. And when I say it for a very short period of time, it's because we immediately saw a drastic decline in mortgage applications. So for the few people who were still applying for mortgages, they were making more profit per loan that they closed. However, with the overall decline in mortgage applications, their total numbers, their total revenue, and their total profit began to decline, and at a very rapid pace, because the Fed began to increase interest rates even faster and more aggressively. So here we are today. We've got mortgage refinancing having dropped to a 22-year low as interest rates are surging even higher. And here's the thing: mortgage loan officers, banks, financing companies, these companies are losing their ASS right now. And shit's actually hitting the fan for them as we speak. Now, these banks are getting desperate. As a matter of fact, this particular loan officer, this particular loan processor, she was telling me that it is so dead in the office right now. They're telling people not even to come in the office. They're fearful of being completely just laid off and fired. I don't know if it's fired is the right word, but certainly laid off, because there's not enough work to be done. And I'm not sure if all banking or mortgage lenders operate the same way in terms of their compensation and their pay scale, but this particular loan officer, she was telling me that she gets salary plus commission. Well, obviously the banks make money on their credit card fees. If they issue a Visa or MasterCard, an American Express card, banks don't issue American Express cards, but Visa or MasterCard, they're making money on those interest and fees that they charge to the credit cards. So that's one segment of the business that they're still making money on. But from the housing market side, from the lending for mortgages side, they're losing their butts right now. And they're paying these loan officers and loan processors to pretty much sit on their hands because there's nothing to do for the most part. I mean, they're still closing some loans, but it's not nearly at the volume as it once was. So they don't need as many people to be in the office to sit around and do nothing. They could literally downgrade, and this is what they're doing. But for her, she hasn't been laid off yet, but she's worried about it. And so she's out like literally hustling, trying to get more business to come in, even beyond the marketing that her bank or mortgage company does. Well, she was telling me that she went to like different retailers like Costco, Sam's Club, Walmart, Target. She's working on trying to secure a part-time job to help supplement her income, because while her income was really, really high, she, purchased a nicer car. She got a larger house, more expensive house. And unfortunately, her income isn't supporting that right now. Now, much like any other market, we have ups and downs. And so this is a cycle that we're in right now. There's a financial cycle that we're in right now with the housing market. And but what we don't know is we don't know when this thing's going to turn around. However, she did mention that things may actually start to pick back up for her, hopefully, in the short term at her company, at her mortgage company. So we may actually see something really, really crazy going forward. Now, if you guys remember back in 2008 during the Great Recession, it was really actually before 2008. So maybe if you go back to 2004, 2005, 2006, 2007, leading up to 2008, you had these types of loans. They were like no doc loans, stated income loans. These were the types of loans that pretty much anybody could get with a pulse, or some people even got a mortgage with even no pulse. And I apologize, I just woke up, so my voice is a little weird, but so we experienced this massive housing market crash back in 2008, 2009, 2010, largely because of these mortgage-backed securities, these stated income loans that all basically they were low quality loans, meaning these were really subprime, in all actuality, in a lot of cases, unqualified home buyers that couldn't afford to hold on to these properties, and they didn't have anything to lose. I mean, a lot of these home buyers back in the day who had these stated income loans and subprime loans, they didn't make any down payments or any kind of substantial down payment, maybe $1,000 or two. So it really wasn't anything. Or some of these people, they managed to not put any money down. Seller paid for closing expenses. So they literally had nothing to lose. It was literally no different than being like a renter with a very low credit score, having minimal to no down payment whatsoever. And then all of a sudden, they lose their job or some type of financial hiccup happens and then they need to leave or they can't afford to pay anymore. They get foreclosed on in the case of a home purchase if you have a mortgage, or they get evicted, without the foreclosure process if they had if they were just renting. And it was really no different to them. I mean, in both cases, the credit would be ruined, but they didn't really care. It was like, hey, we didn't lose our down payment. There was no money associated with it in terms of a financial loss. At worst case scenario, they were homeless or had nowhere to stay, and they maybe stayed with a friend or something like that. Who knows? I don't know what happens after that. But so you got these new loans that are coming back out, but they're not really new. These are the Nina loans, and these are what they call a no income, no asset mortgage. And basically this no income, no asset loan, also known as the Nina loan, it allows you to get a mortgage without providing any pay stubs, tax documents, or bank statements to verify the source of your down payment funds. I'm just reading this. And so it was once a popular mortgage option in the years leading up to the Great Recession, and the Nina loan had largely disappeared, but it's now making a comeback. Why is it making a comeback? In my opinion, I think it's making a comeback because banks are losing their ASS right now. These banks are, number one, people are losing their jobs. People in the mortgage industry, mortgage loan officers, loan processors are losing their butt right now. I was just telling you that the lady I ran into, she's trying to get a part-time job over at Costco, Target, Sam's Club, all these different Walmart, all these different stores that she normally shops at. She was saying she was trying to land a part-time job just to kind of make ends meet because it's been rough for her. And the problem is that she's having a hard time getting them to call her back because, as we talked about this in previous videos, companies, they're canceling orders. They're canceling orders, which is crazy going into Q4, going into the holiday season. These companies are canceling their orders, and it's like, all right, well, what are you guys expecting in terms of the demand from the consumer? Q4 for the retail space is it is the biggest, most profitable quarter for retailers, hands down. I don't care what retailer you are, you fall in the bucket of you need to make money in Q4 because Q4 determines the year's profitability. And so, yeah, that's a huge problem right there. So these banks, they're getting desperate and they're lowering their standards, bringing in these Nina loans, which will be a temporary relief for the housing market. So it's like, okay, if you can get a Nina loan, now that's another transaction. That's another house sale that can happen that normally wouldn't have happened. That's also that could potentially be another person who's buying a house who doesn't have to rent. And so that could add a little bit of relief to the rental market. But the thing that really concerns me is that with the way that they're doing this, this could literally just be a temporary bandage for a long-term gunshot wound, for example. So let's just pretend that the economy gets worse, unemployment rates continue to tick up based on what Fed Chair Jerome Powell has already warned us about, the continuing interest rate hikes from the Fed, driving up unemployment rates. More and more people, potentially millions of people, lose their jobs. And generally speaking, the subprime mortgage loan application group of folks who qualified for these low, no down payment, these Nina loans, these subprime loans, they're going to be, generally speaking, the first to lose jobs, statistically speaking. And they will be the first to be foreclosed on, get behind on mortgage payments, blah, blah, blah. So this could create a new housing crisis so it could be a bubble within a bubble. And this could get real ugly real fast. And We've even heard from talking about layoffs. We've heard from DocuSign. Their new information has been released. It looks like DocuSign is planning to cut workforce by 9% as a part of a restructuring plan. And we just keep seeing this. We're seeing more and more of these warning signs. So I really hope that families are preparing. I wanted to let you guys know a little bit about this shift and this encounter that I had with this mortgage loan officer, because this is the future. This is at least our short-term future potentially. And I'm going to keep monitoring the situation because it's going to continue to unfold. And again, my prayers and thoughts go out to the families in Florida. Hurricane Ian is definitely getting near Florida with landfall with 155 mile per hour winds expected. So things could get ugly. So I hope you guys are preparing. I hope you guys are being safe out there. And I'll continue to bring you updates going forward. You guys be safe out there.